we're calling this one boosting P&L per day. When backtesting strategies, one goal is to see which strategy and management style yield the greatest P&L per day. It's also been shown several times that managing winners maximizes P&L per day, but optimizing this metric relies on capital constantly being deployed. You know, TP, when you take a trade off, how important is it to you to redeploy that capital quickly?
It is very important that I am always looking for opportunities. So I have the opportunities in place. When I take a trade off, I just go immediately into that new opportunity. So it's when I trade options, I'm always looking for the next thing, right? So that when I see a trade that either, hits a metric, 21 days, 50% max profit, whatever, I know what I'm going to do. So it's very important.
So for example, if a trade was managed for a winner after 10 days, capital should be redeployed into new trades as quickly as possible, just like TP said, to keep the P&L per day at work. The P&L per day of cash is basically zero. And this is essentially kind of where you were going, TP.
So one of the things I don't like to hear people talk about is they're waiting to get in the market, either long or short. They're trying to time the market. It is there. If you are waiting for the S&Ps to do something specific, you're looking at too few things. Okay. There are other stocks you can buy. There's other things that you can employ your capital towards. Waiting for something to happen before you deploy your capital, you will die before you find it. It'll never be perfect. It'll never set up.
How does the performance of not immediately redeploying compare to holding the trade to expiration? Would it be better to hold to expiration if the cash will sit on the sidelines after managing? This will present the case to always maintain active, even if the opportunity isn't abundant. And that's a question a lot of people have. Like, what is, should I do something if I don't have, 70 or 80% or 50% IVR, is it still okay to do something just to remain active? And I think we're going to show here today that it is. So we did a study for 10 years, sold the at the money put 45 days to expiration. Now remember, this market's been in a bull market, so this is going to be, the results are going to be good. Yeah.
Right.
We compared a full set of data and of managing in 21 days, then immediately placing another trade, or managed 21 days and then waited until expiration to place the next trade, cash on the sidelines. And again, this is what we said. It's a good marketplace. Let's go to the first slide.
Yeah, and to make sure everybody understands, there are 3 tests here. You manage it 21 days, then roll into the new trade, manage it 21 days and stay out of the market, or hold that trade until expiration. Those are the 3 tests.
So managing winners without immediate redeployment greatly underperformed holding to expiration. This highlights the importance of capital redeployment when maximizing P&L per day.
That's astounding.
It is.
I've never seen this before.
Yeah, it's a very cool. It's a very cool slide, and
I have never seen this before.
I don't think I'm just putting it up on the screen right in front of me so I can see it even clearer. I don't think that we've ever shown this before, but it's now again, the one thing you have to realize about this is that this is a good market, right? It's a bull market.
Yeah, if you've been bullish over the past 10 years, you'd be making money. I understand the hold to expiration is kind of a scratch. I get that. Because like we were talking about earlier in the confirm and send, do I want to buy options in those last couple of weeks? What happens when you get close to expiration is the winners can turn into losers. They become binary trades. There's no way to fix them. So I understand that green line is fairly flat to a little down. And I understand that managing and redeploying the blue line is higher. But not redeploying immediately is just a steady downward drift. I had no idea it was that bad.
Yeah, that's it. Again, it's super interesting because we've never shown specifically this before. But I mean, I don't think it's a shock. I don't think we realized it was quite as dramatic. And,
No,
and the red line at the bottom is really scary.
Right. That's the point. It's the red line that tells the story. That if you're waiting to redeploy, the opportunity cost of those couple of weeks when I could sell that, 45-day or 60-day option and get that time decay working for me instead of, waiting for 3 weeks to deploy the money, that's a huge chunk of time. Okay. You're basically taking out what, a fifth or something of your trading days in the year. You're not trading. You're not deploying capital for about, I'm doing off the top of my head, about 20% of the year. So of course you're not going to have good performance. You're not playing 20% of the time.
So managing trades early often leads to higher average P&L per trade, particularly when the capital is immediately reinvested. Interesting, immediately redeploying capital can result in even greater returns in a shorter time frame. By managing trades at 50% of max profit, similar returns were achieved even in half the amount of time compared to waiting. Conversely, if the capital is not redeployed, it's generally more advantageous to hold the position to expiration. Well, that's,
that's it.
But here, I mean, what they've really done is lay this thing out quite nicely here. I'm trying to think if there's anything that jumps out at me other than, the numbers are just dramatic when you just instantly redeploy. Doesn't make any sense not to.
So one of the only thing I would add to this grid, and the guys could add this in no problem. So when you look at the average P&L per trade, they're kind of the same. 92 versus 87 for redeploy and wait, and then holding to expiration is a little bit higher. But looking at the 92 and 87, what they don't tell you here is you're not getting the same number of trading days. So if I'm always redeploying, I'm getting 262 trading days a year, something like that.
Yeah, I think we use 250, but whatever.
Wait, what's that?
I think we use 250, but I'm not sure.
Yeah, it doesn't matter, but 250 days. If I'm waiting to redeploy, I'm not participating in those 250 days. So my overall P&L is lower. Even though the P&L per day is basically the same, I'm not participating in as many days. That's why redeploying is a better strategy than waiting. It's as simple as that. Again, in the number of days in the trade, 23 versus 28, that's kind of significant as a percentage difference in time. But the main thing is you are not participating fully when you wait to put on trades.
So takeaways: to take advantage of the higher P&L per day metric when managing winners, it's crucial to always have capital at work. Waiting around for certain opportunities like high VR may not be such a great idea if the portfolio is mostly cash in the interim. And also, we always have multiple positions on at one time, and consider adding capital for opportunities, of course. But the one thing I want to point out is this does not for 1 second mean to ever force a trade. So if you don't like a trade, don't do it. And if you're on the fence because you're not sure if the IV is high enough, or if if you think there's enough volume there or whatever, or you don't think it fits your position or it's too highly correlated, the default is not to make a trade. The default's always to stay smaller and not make it if you're on the fence, because don't do stuff you don't want to do.